Howdy there, folks, and welcome into today's video. Got a very interesting one to react to on this channel here today, okay? Dan Chung, who is the CEO and the Chief Investment Officer also of Alger Management, basically makes a strong case here why you need to be buying growth stocks over the coming months, essentially. And I want to react to it. I want to hear what he has to say. Why should you be buying growth stocks right now? And I want to kind of give my opinion on this, okay? Now, I did a little digging on this gentleman, Dan Chung, and kind of his background and things like that, and also about this Alger, however you want to pronounce it, fund here. Essentially, they are very focused on growth style investment management. The firm's investment philosophy: discovering companies undergoing positive dynamic change. So they're definitely a growth, let's just call it growth-related investment management company, right? And they also specialize in small and mid-cap growth equity investing, which I think is very interesting. So, yeah, I'm going to react to that. Thanks so much for everybody that subscribed to this channel. We are now at 12,000 flipping flapjack and subscribers already. So I appreciate each and every one of you for joining me on the reaction channel. As always, we'll get into this, give my opinion. I would love to hear your guys' opinion as always. Also, if you're looking to join us in the private stock group this upcoming week, check out the pinned comment down there to apply to join us in there and get access to the Discord chat with myself and all the other members. Also get access to our new weekly investor private group investors report, which is absolutely amazing. Get access to the popular chats like Tesla, Palantir, and many others, and also get access to all the different course curriculums I have teaching different things out there. Alrighty, folks, let's get into it.
First of all, let's get your sense of how turbulent the time is. Are we headed to a recession or not?
We do think we're headed towards recession at this point, yes.
And how bad, how long?
Well, recessions are, of course, very feared events. One of the interesting things about the stock market is it's been a great predictor of recessions, and typically stocks peak 8 to 10 months ahead of a recession. Stocks peaked at the end of
Typically, stocks peak 8 to 10 months before a recession. That's very important.
December, early January this year. So although NIBOR hasn't officially declared a recession, the stock market is saying we're probably in recession now as we speak.
So, Dan,
the stock market actually peaked in November of 2021. He mentioned about January there, but the real peak was in November of 2021, and that's where basically every single stock in the market, especially all the large caps, peaked in that November timeframe. So yeah, interesting. If you do the math on that, we're in recession right now, which the government says we are not, whatever.
Things that we've seen a lot of in the moving of funds, as well as people talking about it, is as we go into these turbulent times, people are saying that's the time you want to go into value. You don't want to be in growth. And in fact, if you look at some of the big funds, they've lost a fair amount. The growth funds have lost a fair amount. What does history tell us about when you go into recession, where you want to be?
Yeah,
so one of the things I love here is that they're getting into growth, which is something that is preached against right now. I want to be quite clear about that. You watch CNBC, you watch any of the Wall Streeters that go on these different channels, and everybody in general in the investment community, everybody's like, you need to be in safe stocks right now. Not growth stocks. Almost no one out there is saying you need to be buying growth stocks right now, right? And it's because 99% of investors are just a bunch of sheep. They are, and it doesn't matter if they're on Wall Street or not. They just follow each other around, and if everybody's piling into growth stocks, they're going to pile into growth stocks as well and tell everybody else to pile in. If no one wants a piece of anything growth related, which is the market we're in right now, they're going to say stay far away from those. Just go to the safety stocks, value plays, those sorts of things. It's just a bunch of sheep leading each other around. So I always appreciate a perspective that's different than what you're hearing out there. I also always appreciate bear perspectives in a bullish market as well. It's nice to hear somebody that has a different frame of mind than everybody else out there.
Really important point. I mean, history, there are patterns that you can invest in, even in turbulent times, even through recessions. Very important to understand that because essentially it's about having a game plan, during economic volatility and recession. And what the history tells us actually is that as we enter into recession, growth stocks, in other words, companies with strong business models, low debt, operating margins that are higher than average, they tend to do better than, say, highly leveraged companies with lots of operating leverage. In other words, a fixed cost structure And of course, companies that weren't growing particularly well before, that only tend to grow with.
And you know what's interesting, okay? I want to show you guys something here. This is very interesting because, if you look at it's called safety stocks, right? Because these are stocks that everybody says, oh, you got to be in these sorts of stocks, okay? And remember what he just said there. And if you go up and down, like the stocks that people say are so safe, right? And, you're going to be saved if you buy these stocks, essentially, right? All those stocks pretty much are highly levered in massive amounts of debt and have very fixed cost structures with their businesses. So think about that for a moment, right? And he's saying you actually don't want to be in those sorts of companies moving forward. So I just think that's an interesting perspective because it's so counterintuitive from what 99% of people are saying out there in the market right now, right? And it doesn't matter what of the stocks, of safety stocks you pretty much pick, they're almost always all super highly levered, and I mean ridiculous, like insane amounts of debt. So yeah, it's just something to keep in mind there. Whoa, I went big.
Economic growth. So what we have seen in the past historically is that as we enter into recessions, value companies, value stocks, tend to have significant earnings compression, declines in earnings. Well, growth stocks actually tend to hold up fairly well. Now, the other part of history that's important to note is the first stage of a market correction is really valuation compression. And we've seen that across the board. And it is also classically true that growth stocks compress more than value stocks. But I think we would actually see a lot of signs that part of this market cycle is already over. The next part is really about the economic recession.
That's
but
interesting.
I think we would actually see a lot of signs that part of this.
Whoa! Wow, that's pretty telling. That chart there, that is pretty darn telling. Okay.
The cycle is already over. The next part is really about the economic recession and the decline in earnings that it will bring, across the market, and that's where actually growth stocks start to shine.
So Dan, I think it's important in what you said there. It's not all the companies that are considered growth companies. You have a subset that you really focus on.
Yeah, it's really interesting. Alge's philosophy is focused on fundamentally the disruptors and the innovators across industries, as well as a category we call life cycle change, which are sort of companies that may have experienced tough times that we think are about to experience better times because of innovation or management and leadership. We have some interesting history from top growers. In particular, if you look at the top 75 companies across the largest 750, so the top 10% of growers.
Wow. Fastest growers' relative price to sales ratios. And this kind of shows you throughout time, and obviously there's certain time periods where it gets insane, including recently, back in 21. But geez, look at that. Fastest growers relative price to sales ratio. Look at how low we are right now. We're at numbers even lower than where we were kind of in that December 2018 time frame there, right? That's extraordinary. We're lower than we were in the great financial crisis by a lot, right? That is, wow. That's pretty darn telling, folks. Pretty darn telling.
Their valuation actually has compressed so much that relative to the market now, they're actually at multi-decade lows. And that, again, gives us some confirmation that it's really probably time to start thinking about not so much the start of the recession, which, as I said, probably has started already, but what it looks like coming out of recession and into recession. And that's where, again, these kind of growth stock leaders, the valuations have compressed, the fundamentals are likely to hold up better than average and certainly better than value cyclicals. And we think it's, a good time for long-term investors to think about the opportunities there.
So Dan, let's go a little more specifically if we could, because we want to try to help investors make some good investment decisions here. What specifically would you be looking at right now in those growth companies you described?
Imagine he totally loses us right here and he's like, I think Peloton. something random like that.
Sure. So I think one thing you look for is what are the strongest trends in business and in society in the world? And then, of course, the companies that are leading that, right? The disruptors, the ones that are taking market share. Digital transformation of business is sort of where machine learning, big data, cloud computing all come together, right? This is all about making businesses more efficient. efficient in their cost structure, and efficient in how they manage their employees, getting more productivity, and of course, efficient in reaching and servicing their clients. And so, when you think about the center of that, that's really software. That's what's driving it. And then, of course, the powering of that is semiconductors and hardware. But think about companies. We think like companies like Veeva, which focuses on the healthcare industry and making everything from clinical trials to product recalls more efficient. Vast amounts of data that help improve clinical trials results to target medicine, but also lots of...
I just want to see what this Veeva, that's not a stock I tracked there. Let's see what this baby's trading at here. Good old Veeva. Anybody ever heard of that one? So Veeva Systems. I mean, I'm in stocks all the time, and still there's companies that just come out of nowhere, and I'm like, what is this company? What do they do? So it's trading at $27 billion market cap and price to sales ratio about 13, which seems pretty high. But I mean, you go throughout time, it was trading at 28. Wow, all the way up to 35 back in October of 20. It must have got caught into the healthcare cycle of Rona. It must have some big positivity going. Back at the March lows, somewhere in there, it was trading at an 18 price to sales. So that's interesting. Right now, the stock trades much cheaper than kind of around Rona lows. That's pretty intriguing. But back in 2018, for instance, it was trading about the same. So right now, the stock's trading about the same, right? Roughly as on a price to sales ratio as it was back then. And P ratios, obviously. So it's interesting. Back then, they had like a 70. See the numbers over here? So as I'm going throughout time, 70, 90, Up here, they're at like 100-something P ratio. And then recently, at 72. So, interesting. I don't know. I don't know much about that one. Probably not my circle of competence. Probably not one I'm going to research. We'll see.
To make sure that if there is a recall, they know exactly, why there's a problem and how to recall it and who has it. It's companies that are, also, for example, of course, transforming every business by moving to the cloud and helping them do that. So every business uses a lot of software. Companies like Datadog, they do application performance monitoring on the cloud. That means, if you have 100 applications running across your company, that may be payroll, that may be marketing, that may be customer service, and that, of course, may be your manufacturing or core service capabilities. All those applications, you need to monitor them for their performance, the downtime, the accuracy. And Datadog, for example, is a company that provides software that helps you do that, basically manage your digital infrastructure. So data transformation is incredibly important because particularly in a recession or in difficult times, the most important thing businesses want to do.
All right, let's check out this Datadog. Datadog I have heard of before. I don't track this stock. I'm fairly certain it's one of just many growth stocks that's gotten leveled so far this year. But let's go ahead and see the good old doggy. So Datadog, wow, they like the 20-something billion dollar market caps over there, huh? $28 billion market cap on this one. Price to sales ratio 21. I mean, just anybody that knows anything about price to sales, it seems rich. But gosh, what was it? Oh my gosh, Datadog was up to a 68 price to sales ratio at one point. Holy smokers, it ain't no dang jokers. Yeah, and this stock peaked out close to 200. It's about half that today. So interesting. Yeah, I might have to do some more digging on this eventually. But geez, I mean, just base level look at this one. It's like a 21 price of sales. But when these sorts of companies, oh my gosh, they command massive multiples. Always do. It's just the way they are. Anything SaaS related, cloud related, software as a service. I mean, they trade rich. They always do.
Get more efficiency out of more limited resources, right? Maximize their efficiency.
So Dan, when you talk about life cycle changes, it strikes me that one of the places we're seeing a huge change right now is in energy. As we go toward renewables and we also try to get more efficient in our fossil fuels, what sorts of opportunities do you see there, if any?
An ad?
I invest in Invesco QQQ, a fund that gives me access to NASDAQ 100 innovations like CGI.
What? No.
Become an agent of innovation with Invesco.
Hey, that's not okay. I'm not getting paid for this ad. That's not okay, Invesco. You better advertise on my channel, Invesco.
That's absolutely correct, David.
My channel.
We have liked the renewable sector.
Quit messing around.
Solar, wind, EVs. battery technologies that are going to power electric cars as well as backup power for a long time. But given the Ukrainian-Russian war, the effect on oil, natural gas, and other prices, the traditional energy industry, which had been in a bear market, is now poised for a transformation, what we call life cycle change, a growth renaissance. And the reasons are very clear. America is, fortunately, now a world-leading energy producer across many fields, not just renewables, but the traditional oil and gas. And, liquid natural gas, for example, we're a leading producer. Companies in the U.S. are important not only in producing natural gas, but, for example, the processes and logistics to ship natural gas in the liquid form across the globe. So we're very excited about the opportunities in that area.
And just to be clear, that's not new, in terms of fracking for natural gas. I mean, that started to really take off in a major way. Oh, gosh, that was probably around 2003-ish, if I recall, 2004. And then in terms of fracking for oil, that really started to take off like crazy in around 2010-ish or so. And then just really ballooned over the past decade or so. So, it's, I don't know if people just haven't been caught up on this, but it's not like this is like new stuff. Like, oh, we just made this happen. It's like this has been going on, man. Whoa, I went big again.
As well as the renewables area.
One more that applies perhaps to all the growth companies. In general, I think growth companies is, if you look at the life cycle of their earnings, more of them are out in the out years. As interest rates go up, that means there's a steeper discount back to present value. Does that warn you away from some growth companies because the interest rates look like they're going to keep going up for a while?
Well, and that's part of the reason why tons of growth stocks are down 60, 70, 80, 90% in some cases, because the way they run valuations with DCF models and dividing it out by whatever the current Fed funds rate is.
So that's absolutely correct. It's what we've seen already, I think, the valuation correction for the fastest growers, because yes, the opportunity for growth stocks is, what they do 3, 5, 10 years from now, in terms of revenues, earnings, and cash flow. But as interest rates go up, those cash flows, those future opportunities get discounted. And investors, of course, become very fearful and tend to focus on the near term. But by many measures, in particular, in the large cap sector, the valuation compression has already gotten to the point where large cap growth stocks are actually relatively cheaper than they have been in decades against the market. And so, we think it's an opportunity to start picking the best of those growth stocks for of course the inevitable market recovery.
So in all due respect, there, I'll pull you guys up the latest Yardini numbers. But I mean, when it comes to large caps should be trading the richest of the bunch, small caps and mids trading way cheap. But I'll pull up the latest Yardini numbers. We'll take a look at those. All right, so take a peek at the latest numbers here. So this was updated as of September 13th. So the market weakened considerably over since September 13th. So do keep in mind that all these numbers you see are likely in reality lower than what you're going to see right now. But I mean, large caps are definitely trading fair. I would call them that fair, but I wouldn't necessarily say like large caps are super cheap right now. Mid caps insanely cheap right now. Small caps ridiculously cheap right now. Just kind of looking at those numbers. So that's kind of my standpoint there. But yeah, in terms of me and kind of my thought process, I think this next 90 days, 120 days, it's like, especially if this market continues to weaken, oh my gosh, like, you got to be buying the growth. If you're not buying the growth, I just don't know what you're doing, man. There's so many great opportunities already out there. Never mind if the market gets more pain behind it over the next, few months. Very rarely you get opportunities in major growth stocks that have, 5, 10, 15, 20 years of runway in front of them and get those companies at let's just call it cheaper valuations. It comes very few and far between. When you get those chances, which hardly ever happens, you got to take advantage. And so that's exactly what I'm doing. And that's just kind of my views on that. I hope you guys enjoyed today's video as always. Once again, if you're looking to join us in the private stock group and get access to everything in there, check out the pinned comment down there to apply to join us in there. Much love and have a great day. Thanks for being subscribed.